China's big real estate company, Evergrande, is in deep trouble with over $300 billion in debt. This issue isn't just China's problem. It could affect homeowners in the U.S., too. Evergrande is a big part of China's economy, and if it fails, it could shake up markets all around the world, including in the U.S. This situation shows how connected our world is. Problems in one country's economy can impact others, like changing mortgage rates and home values in the U.S. For example, U.S. mortgage rates are at around 7.8% now, but if markets get shaky, these rates could change. Also, U.S. home values, which have been going up by about 5% on average each year, might not grow as fast if things get tough globally. If Evergrande collapses, it could scare investors everywhere, making them less willing to take risks. This could lead to less investment in businesses and fewer jobs, not just in China, but around the globe. In the U.S., this might mean higher interest rates as investors seek safer options like government bonds, making loans more expensive for Americans. It could also mean trouble for U.S. companies that do business in China or rely on Chinese manufacturing, potentially leading to higher prices for everything from cars to electronics. Remember the 2008 financial crisis? We know how quickly financial problems can spread around the world. So watching what's happening with Evergrande in China isn't just about being interested in global economics. It's about understanding things that could directly change the U.S. housing market, like mortgage rates, currently at almost 8%, and the growth rate of home values. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. In today's video, we're going to break down the 10 reasons why the bursting of China's property bubble should be on your radar. Ever thought about how a housing crisis far away could impact your home buying or selling plans in the U.S.? Let's explore how deeply connected the U.S. and China's economies are, especially through real estate. The U.S. and China, as major trading partners, share a bond where economic issues in one country can swiftly affect the other. At the heart of this lies Evergrande, a colossal real estate entity in China, saddled with a debt exceeding $300 billion. It serves as a symbol of a looming crisis reminiscent of the 2008 U.S. housing bubble collapse. Consider this. Chinese investors have invested about $32 billion in a single year from 2016 to 2017 into the U.S. real estate market. Their significant role means any economic troubles in China could cool down markets in U.S. cities previously buoyed by this investment, affecting property values and market dynamics. The global repercussions of the U.S. 2008 crisis remind us of the potential domino effect of major economic downturns. Moreover, a downturn in China could shake global investor confidence, possibly leading to tighter credit conditions and higher interest rates for Americans. The Evergrande crisis illustrates the intricate connections of the global economy, highlighting the importance for U.S. homeowners and buyers to stay informed on worldwide economic trends for smarter decision-making in the housing market. Have you ever wondered how a financial ripple in China can turn into a wave affecting your investments and even your mortgage rates in the U.S.? Let's dive into how China's property market, with a spotlight on the Evergrande crisis, has far-reaching implications that touch corners of the global economy, including the interest rates you pay in the U.S. How does the turmoil thousands of miles away influence the financial landscape right at your doorstep? Chinese companies like Evergrande are major players in global markets. Their influence isn't confined to China. It stretches worldwide, impacting investment patterns. When Evergrande faced a debt crisis, it didn't just shake the Chinese market. Global indexes, including the Dow Jones, experienced significant drops, illustrating our financial interconnectedness. The global reaction affects you directly. Global market instability can lead to tighter credit worldwide, potentially raising interest rates and making loans more expensive. However, it's not all bad news. Experts suggest that today's global financial system, fortified by stricter regulations, is more resilient than before. The key takeaway? The global economy's interconnectivity means events in one region can impact financial conditions globally, including in the U.S. This emphasizes the importance of staying informed and ready for economic shifts. Ever wondered who's behind the surge in house and apartment sales in major U.S. cities? International investors, particularly from China, have significantly impacted the U.S. real estate market. However, with China's property market facing challenges, notably the Evergrande crisis, there are questions about how this trend might change and its implications for Americans buying or selling homes. Chinese investment in U.S. real estate has increased in recent years, bringing billions of dollars into both residential and commercial sectors. This investment has boosted property values in key cities, but with Evergrande's debt problems, there's worry about the effects of a potential withdrawal of Chinese capital. In 2020, Chinese buyers were the top foreign investors in U.S. residential real estate, with purchases totaling around $11.5 billion, as reported by the National Association of Realtors. If China's economic issues cause a dip in this investment, markets like San Francisco, Los Angeles, and New York could see a shift, potentially benefiting buyers with less competition and more stable prices. However, it's important to keep a balanced view. The U.S. housing market is influenced by numerous factors, such as domestic demand and interest rates. Any decrease in Chinese investment might have local impacts, but the overall market remains strong, supported by low interest rates and economic recovery. The Evergrande situation highlights the global economy's interconnectedness and underscores the need for U.S. homebuyers and sellers to stay informed. Monitoring these global economic trends is crucial for understanding their potential impact on the U.S. real estate market. The world's supply chains are incredibly sensitive, with disruptions in one part of the globe impacting everything from building costs to the pace of new home constructions in the U.S. The challenges faced by China's Evergrande Group spotlight how vital China is in the global supply network, especially for construction materials like steel and copper. China's real estate sector, a major consumer of these materials, influences global supply and demand. The financial difficulties faced by Evergrande extend beyond mere corporate concerns, carrying broader implications for global supply chains. This could result in heightened material costs worldwide, contrary to expectations of price decreases due to reduced demand in China. In the past year, we've observed significant price fluctuations in materials, with steel prices soaring by over 200% at times. While not solely due to China's market, its substantial role means any instability can trigger global price volatility. For the U.S. housing market, this translates to higher construction costs and, consequently, higher prices for new homes. Supply chain delays can further restrict housing supply, pushing prices up. Yet, it's crucial to recognize that numerous factors, including interest rates and local policies, also shape the U.S. housing market. Global trade and economic experts stress the importance of diversification and resilience in supply chains. For U.S. residents, this underscores the need to stay informed about international events affecting the housing market, guiding smarter decision-making in an interconnected world economy. Ever wondered how financial issues far away can affect your ability to own a home in the U.S.? The crisis facing China's Evergrande Group sheds light on this, potentially influencing U.S. mortgage rates. Interest rates and borrowing costs are at the core of this. They're shaped by global economic conditions, including investor confidence. When global investors worry about issues like Evergrande's debt problems, they often turn to safer investments like U.S. Treasury bonds, driving up their prices and affecting mortgage interest rates. The Federal Reserve, which sets the benchmark interest rate, takes cues from global market trends. A crisis like Evergrande would prompt the Fed to adjust interest rates to stabilize the economy. However, an influx of foreign investment in U.S. assets could strengthen the dollar, affecting the Fed's inflation targets. A practical example, a 0.5% increase in mortgage rates can significantly raise monthly mortgage costs, affecting affordability. Experts urge caution, highlighting the difficulty of predicting market movements due to various influencing factors. Being informed and prepared is key. The situation with China's property market, while seemingly distant, illustrates the global interconnectedness of our financial systems, impacting even the U.S. housing market. Ever caught yourself wondering how the value of the dollar in your pocket can be influenced by economic events on the other side of the globe? It's a fascinating aspect of our interconnected world economy. This crisis in China, like the one surrounding the Evergrande Group, could potentially impact the value of your dollar, your investments, and ultimately your purchasing power. Currency values fluctuate based on a multitude of factors, including economic stability, interest rates, and investor confidence. When investors get nervous about something big, like a major real estate company in China facing a debt crisis, they often move their investments to what they perceive as safer currencies, like the US dollar. Here's a bit of context. The US dollar is often seen as a safe haven during times of global economic uncertainty. When turmoil hits, demand for the dollar increases, which can push up its value. While a stronger dollar might sound good, it can have mixed effects. For instance, it makes imports cheaper for Americans, which is great if you love shopping for products from overseas. However, it can also make US exports more expensive for other countries, potentially hurting American businesses that sell goods abroad. Economists and financial analysts often point to historical trends to predict future movements. For example, during significant global financial crises, the US dollar typically strengthens as investors flock to safety. But these trends also show that currency markets are increasingly volatile and can shift based on the latest news and economic indicators. So what does this mean for you? If you're an investor in international stocks or bonds, a stronger dollar could affect the value of your investments. Similarly, if you're planning a vacation abroad or considering purchasing goods from another country, changes in currency value could affect how much you pay. Experts encourage a measured approach to interpreting these trends. While it's crucial to be aware of how global economic events might impact currency values, they also stress the importance of a diversified investment strategy that can withstand the ups and downs of currency fluctuations. Ever heard of investor confidence? Investor confidence is like the weather vane of the financial world. It shows us where the wind is blowing. When confidence is high, investors are more likely to take risks, pouring money into real estate, stocks, and other investments. But when confidence wanes, as can happen with economic turmoil in a powerhouse like China, the ripple effects can be felt far and wide. You might be wondering, how does a dip in investor confidence on the other side of the globe affect me? Here's the connection. U.S. real estate is often seen as a safe investment, attracting both domestic and international investors. However, if global investor confidence is shaken, say by a major player like Evergrande defaulting on its debts, this can lead to a pullback in investment at a global scale. For the U.S. housing market, this might mean a reduction in the demand for high-end properties, often targeted by foreign investors, which can have a cooling effect on housing prices in certain markets. While direct investment from China in U.S. real estate has seen fluctuations over the years, its impact, especially in certain cities and segments of the market, can be significant. A sudden withdrawal of this investment could lead to increased supply and potentially lower prices, affecting homeowners looking to sell. However, financial experts urge caution in jumping to conclusions. They highlight that the U.S. housing market is influenced by a wide array of factors, including interest rates, employment levels, and local economic conditions. While investor confidence can sway market dynamics, it's just one piece of a much larger puzzle. What's the takeaway for U.S. homeowners and potential buyers? It's about the importance of staying informed and looking beyond the headlines. Understanding the global economic landscape helps you better grasp the forces at play in your local real estate market. It's also a reminder of the value of diversification, not just in your investment portfolio, but in your overall financial planning. Remember the big financial mess in 2008 and wondering how it all added up? Back in 2008, the trouble was with something called subprime mortgages in the U.S., and they were worth about $1.3 trillion. It's a lot of money tied up in risky loans. Now, jump to today, and there's this big company in China, Evergrande, that owes about $300 billion. Imagine just one company owes almost a quarter of what all those risky U.S. loans were worth. When we consider the total debt owed by businesses in China, it amounts to approximately 160% of the country's annual gross domestic product. Before the U.S. crash in 2008, American families owed about as much as the whole country made in a year. These are huge amounts that show when too much is borrowed, things can get shaky. But here's where things are a bit different. The problem in the US was mainly with the American people's home loans turning bad. In China, it's big companies like Evergrande that owe too much. Plus, China's government plays a big part in its economy, which means they might be able to step in and fix things in ways the US couldn't back in 2008. Experts think that the way China handles its big property money problems could stop things from getting too bad too fast. In the U.S., the government had to jump in after things went wrong, trying to patch things up with bailouts and special programs. For folks in the US today, keeping an eye on what's happening with Evergrande in China is important. Our world economy is all linked together now more than ever. A big crash in China's real estate could shake up markets all over the world, affecting things like the stock market and how much it costs to borrow money for a house in the US. Have you ever seen a warning sign while driving and slowed down, wondering what's ahead? Well, there's a big warning sign flashing in the world economy right now, and it's coming from a company called Evergrande in China. Let's break down what's going on and why it's something we should all be paying attention to, even if we're miles away and not directly involved. Evergrande Group is a massive company in China that deals with real estate, meaning they build and sell properties. But here's the catch. They owe a lot of money, over $300 billion. To put it into perspective, that's like if every single person in the United States owed about $900. It's a huge amount of debt for just one company. Why does this matter to us? When a company as big as Evergrande has trouble paying its debts, it can cause problems for lots of other companies and even whole countries. Think of it like dominoes lined up. If one falls, it can knock down a whole line of them. Experts are looking at Evergrande and saying this could be a sign of bigger problems in the economy, not just in China, but around the world. Economies are all connected these days. For example, if Evergrande fails, it could mean less business for companies in the US and Europe that sell things to China or invest there. This could lead to fewer jobs and more expensive loans, making it harder for people to buy houses or start businesses. But it's not just doom and gloom. Knowing about these risks means we can prepare and make smarter choices. Financial experts suggest keeping an eye on the news and thinking carefully about our own money, like saving more and being cautious about taking on new debts. Have you ever set up a row of dominoes, gently tapped the first one, and watched as one by one they all tumbled down? Now imagine if each domino represented a piece of the global economy. That's exactly the kind of situation we're looking at with China's Evergrande Group and its massive debt crisis. It's not just about one company or even one country. It's about the potential domino effect that could impact the world, including the US. Let's dive into why this matters to you and wrap up what we can do about it. Evergrande, with its $300 billion in debt, is like the first domino in a long line. If it falls or fails to pay its debts, the immediate impact will be on its investors, employees, and the projects it's involved in. But the effects could spread much further, affecting companies and economies worldwide. But here's the good news. Knowing about these risks gives us power. We can't control the global economy, but we can make smart choices with our money. Building an emergency fund, diversifying investments, and staying informed about global events can help protect us from the fallout of economic shocks. So what's the takeaway from all of this? The world's economies are more connected than ever, and what happens in one corner can affect us all. But by staying informed and prepared, we can navigate these challenges and keep our financial goals on track. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.